Hello, this is Caroline Bell from Summerhill Financial Services, just with another update. Only two things on the agenda for today. First one is the Medibank private offer that's getting close to the final date. And I just had a couple more queries in relation to the Medibank IPO and whether you should participate. As I sort of mentioned in the last video and also a blog post I did, I'm not a big fan of IPOs. I'm sure we can all remember Telstra 2 being issued at $7.40. The main issue with the IPO is the valuations being set by accountants and valuers without any real necessary consideration to what the market price is. However, for those clients where I do manage your portfolio, you will end up with Medibank Private in your portfolio at some point in time. It's either going to come through in your portfolio as a large company through your large company exposure. If it ends up being a small company, it'll come through in your small company exposure. Or if the price drops or it's considered to be quite value compared to what the company's worth, you'll end up with a higher than index exposure in the value component of your portfolio. So any which way, you're at least going to be getting an index exposure to Medibank IPO after it actually issues. The second thing I just want to cover off on is with all the volatility that we've been experiencing the last couple of weeks, so markets sort of took a tumble and then they've come back up again, just wanted to talk through your portfolio mix. So just because markets are cheap doesn't necessarily mean it's the right time for you to buy, and it's going to be a consideration of quite a few things that I take into account. Particularly if you're coming into, if you're planning on stopping work within the next 2 or 3 years, we really want to look at making your portfolio a little bit more conservative, because you're not going to have that income coming in to replace anything that's lost or to buy in cheap in the future. So we want to actually start focusing on preserving what you've accumulated, not sort of chasing an extra 1 or 2% return. The same applies if you're looking at buying a home in the next 1 to 2 years. Again, depending on your cash flow, but if we're sort of building up a portfolio that's going to be sold to fund a home within the next 1 to 2 years, we don't necessarily want to be taking a lot of risk and incurring more volatility. It also sort of goes with anyone that's accumulated sufficient assets that they don't need to take on that extra risk. So you each have a mix of investments in your portfolio that is our long-term target. We'll often go just over or under that long-term target, but that's sort of one of the considerations that I have when looking at your portfolio. So everyone is different. So particularly in the last period of volatility, we might be buying bonds for someone and buying shares for someone else. It just depends on where you're at, what your goals are, and also just what your comfort level of investment mix is. I hope that helps. As always, if you have any questions, feel free to send them through, and I look forward to seeing you soon. Bye-bye.